Let's start this part of the program with Larry. He's in Burnaby, BC. Hi there, Larry.
Hi, Mark and David. Thank you, Mark, for taking my call.
Sure.
David, I'd like to know about CSX Corporation. I'm thinking of taking a position in it, but I noticed it's close to its 52-week high. Would you be a buyer at this level, and what do you think of this organization going forward? Thank you.
So, Larry, thanks very much for your question. When we look at the world, and I can only look at it through our lenses, we first look at sector, and clearly the rail sector is one of the strongest groups in the market. You know, this group is benefiting from a lot of key themes, one of which is some recovering in manufacturing. But I think that really the biggest driver right now for the industry is the increased rail loadings, or car loadings in oil and petroleum products and chemicals. There's such a growth in supply taking place that the pipeline system can't handle it, and as a result, a lot of it's being shipped by rail. So I would prefer to focus on the rails that are more specific to this theme. CSX is more focused on the East Coast. I would focus more on the West Coast rails, like a UNP, that benefits from the oil rail car loadings, but also from north-south trade between the U.S. and Mexico. I might also focus on a CNR or a CP. I think you're not going to go too far wrong in the group. I just think that CSX might be a slower mover in the group. They're all trading near the highs, but I think that this is a long-term theme, and I think that Warren Buffett was no dummy when he bought Burlington Northern. He could see some of the things that were coming at the marketplace. So I have no problem with CSX. I would prefer UNP or CP or CNR, or even a Kansas City Southern, which would be more beneficiary of trade between U.S. and Mexico.
Of those stocks that you mentioned, which do you hold?
We own UNP, we own CNR, we own CP, but I'd be more than happy to own Kansas City Southern as well.
Okay, very good. Here's an email. This is from Art, and it's on stop losses. On your visit last October, you addressed using stop losses as a risk management tool. Could you comment on the accuracy that you suggest selling stocks 10% below the 20-day moving average?
Yeah. Well, so look, stop losses as a concept simply come down to the fact that you should have a risk budget, right? We all want to make money. Investing isn't about being perfect. We're going to make mistakes. You've got to limit the downside. And so we use stop losses to do that. Now, I use point and figure charts, which are a little bit more complicated, to help identify inflection points where things are changing. I think if you want to use a moving average, you can. I would say if you're a shorter term investor, you might use a 20-day smooth moving average. If you're a little bit longer term, you might use a 50-day, or if you're a very long-term investor, you might use a 200-day moving average. I would not use the moving average itself because specifically there's too many people watching. And very often you'll see things dip down below the moving average and then reverse. So using 7 or 8% below the 20-day moving average as a more tactical investor might be a good way to go. But I think the idea that you have a fixed limit in mind is more important than the actual strategy you use to identify it.
Does it often happen, David, that you're in a stock that you like and you get stopped out and you kind of go, oh, darn it, I wish I hadn't? Yeah,
you know, the reality is that does happen. When I look at it, at the end of the day, I think the number one thing that our clients care about is not losing the money. So from time to time, we give up some upside. There's no question about that. But the reality is you can afford to make little mistakes. You can't afford to make big ones. And stop losses, if you do it religiously, as we do, we follow stops on all of our positions. It's a discipline that helps you to make sure you live to fight another day.
Okay, here we go with Jim. He's in Whitefish, Ontario. Hi, Jim.
David, you're talking about stop losses. Stop loss on Suncor. Do you do them daily? You worry about market pullback and seasonality and stop losses? Thank you.
Right. So, Jim, before we enter a position, we identify a price below the price we've paid where we go to the sidelines if the position doesn't work. You know, we'd love to think they're all going to work, but we know that situations change, new information comes out, maybe we don't have all the information in the first place. So, you know, certainly I think that it's important. On Suncor right now, the problem that you're facing, and it's the same for many of the producers in the West, they're getting a big discount for their oil because of the lack of infrastructure and ability to get it to market. Operational costs are high, and as a result, I think there's a lot of investors who'd prefer to own the infrastructure companies than the producers themselves. So, you know, on the Suncor, you know, it's even trading below the 200-day moving average. There may be value investors out there who would say, boy, this is the time I want to buy it when nobody else wants it. But we're in a strong market. And in a strong market, you got to participate. You got to identify the things people care about now. And I think, sadly, the energy patch right now does not appear to be the place to focus.
So no holdings there of Suncor?
No holdings of any
of the
major producers.
Okay. Here's Lorraine, who's in Edmonton. Go ahead.
Oh, hello, and thank you for your help. I noticed this morning that Agrium got a downgrade. Do you expect more downgrades on Agrium?
Well, Lorraine, you know, one of the problems right now is that in agriculture, agricultural prices have been weak, and that has been a negative for the group. Now, Agrium had been one of the better performers, and I think that the downgrade today was more on valuation. If you broke it up into the sum of the parts, that analyst's view was that it wasn't worth where it was trading today. I think you can argue that point in a number of different ways. The bottom line is we're not so focused right now on agriculture. If I had to own one, Agrium probably is the best performing one of the bunch. So, you know, we look for, in a group that's underperforming, which is the one that is behaving better than the rest. And I think that Agrium fits in there. I think probably also Monsanto fits into that camp. So I think there's better sectors right now. We're coming into a time of year where maybe you see it get a little bit better. You know, seasonally, the spring gets a little bit better for these companies. But I wouldn't be in a hurry to go out and buy them.
Okay, David, a short break here. We'll come back and more questions for you on North American large caps.